Okay, welcome to our taxation class for today. We are going to be learning something in continuation of what we did in the first class. I want to appreciate your coming early today, and we hope to have a nice time today in class. So let me share my screen so that we can start this class immediately. Okay, I believe you can see my screen at the moment. So today we'll be talking about capital allowances. Now, I also want to assume zero knowledge, so to speak. Even though this is a refresher, course, I want to assume zero knowledge. And so I want to pass across the message to you in such a way that to add value. Now, like we discussed in accessible profits, capital allowance is also very important so you can determine the tax of any company or sole proprietor. Okay, now this is the formula to get your tax. You have to convert your net profit to accessible profit. So when you convert your net profit to accessible profit, you are now making your profits in such a way that it is ready to be taxed. Now, after getting your accessible profit, which we did last time, after getting your accessible profits, what we'll do is to convert it to what they call taxable profits. And for you to convert it to taxable profits, the element of capital allowance must be there. And so accessible profits less capital allowance will give you your taxable profits. And so capital allowance is very, very important. Now there is this concept in accounting called matching concept. The matching concept is such that all the income from a particular period of time is matched with the expenditure that bring about this income in that particular period of time. Now, following that principle, the capital allowances are going to be matched in the same period of time with your accessible profit. So you cannot be claiming a capital allowance that is not in the same period of time, so to speak. So that means that the basis period for capital allowance will match the same basis period for accessible profits. If everything goes smoothly, that is how it's going to be. Now, it means that if tax accessible profits is looking at preceding year basis, capital allowance is also looking at the same thing, preceding year basis. In the last class, we talked about abnormal basis period. And so this abnormal basis period is still causing a problem in capital allowance. Now, while we found a way to deal with abnormal basis period in the accessible profit when we talked about the commencement rule, the change of accounting rule, and the cessation rule. In capital allowance, there are two things we should bear in mind. First of all, capital allowance does not allow for overlap or gaps. I demonstrated last time what an overlap is and what gaps are. Okay, so normally in commencement of business, you usually have overlap in the first year and second year. There's usually an overlap. So the first year, let's say a business started from September 1. So you find out that the first year will be September 1 to December 31st. That's fine. The second year will also be from September 1 to August 31st the next year. And so there is a kind of overlap, and the overlap is that September 1 to December. Now, the problem with capital allowance is this. If you buy an asset in, say, September or in November, and you know these 2 years of assessment has this same period, which period will you be charging your initial allowance? That is a problem, because you tend to be charging, if it is not cleared up, you'll be tempted to charge it twice, one in the first period and the other in the second period, just because in assessable profits we did it twice, but in capital allowance we don't do it twice. Now, how do we deal with this issue, especially in commencement rule? One of the things capital allowances solve is this. For initial allowance sake, any assets that is bought between a period of overlap is treated in the first period that it appears. In the second period, it is not treated. So the asset belongs to the first period in the two years of assessment when compared. So in that example, when you bought an asset in, say, October, it belongs to year 1, even though year 2 also have an overlap of that period. You will not consider it for initial allowance in year 2, just year 1. Now, what about the other extreme, which is called gaps? Just hold on a moment. Give me 1 minute. Okay. So, what about the other extreme, that we have a gap? When do we usually have a gap? I told us in change of accounting dates, as you are transitioning from the old accounting dates to the new accounting dates, there may be overlap, there may be gaps. Also, when you are doing cessation rule, there is bound to be gap. And so let's say there is a gap between September 1 to December 31st. Let's say a company was using December 31st before, and it now changed to August 31st. So there's bound to be a gap between September 1 to December. And so what happened in that gap? If an asset is bought during that gap, how will it be treated? Will it be excluded? So in capital allowance, when there is a gap, the gap belongs to the second period. That period of gap belongs to the second period, except if you are doing cessation rule. In the cessation rule, the gap is supposed to belong to the ultimate year, but in the cessation rule, the rule says that is an exception. Give it to the penultimate year. So the formula for gap is that when there is a gap, the gap belongs to the second period, except when you are in the cessation period, when it belongs to the first. You're going to be seeing more of it when we do some questions. Now look at the capital allowance rates. Initial allowance is there, annual allowance are there. So initial allowance is the allowance that you deduct first from an asset. When you deduct an initial allowance first, that is because the asset is being put to use for the first time by the company. So let's imagine that you have motor vehicle, you have a truck, and you bought it for, let's say, 10 million. For the year you use it, let's say you have a January 1 to December 31st accounting year, and you put it into use in August 1st. You see that August, September, October, November, December, we have used 5 months for that basis period. But for initial allowance, you don't prorate. What you do is you take the full 50% off as a capital allowance. Even if it is 1 day, you use it in that basis period, you don't prorate. But when it comes to annual allowance, you have to prorate. How do you get your annual allowance? First of all, you have to know the cost of the assets. Then you deduct your initial allowance. When you deduct your initial allowance from cost of the assets, the result is called it's called depreciable value. You now divide it by the predetermined number of years. The predetermined number of years is gotten from the annual allowance percentage. So you see, when we say annual allowance of 25%, it means 25% on straight line. If you take 25% of something continuously, how many times will you take it for you to get to 100%? 4 times. So simply means that for you to know the number of times or number of years, you simply say 100 divided by annual allowance rate. That will give you the number of years. Now, for the first year, let's say you started using it in August, okay, September 1. Started using it in September. So September, October, November, December, 4 months. You are going to prorate annual allowance for 4 months instead of the whole year. But mind you, okay, let's say August, because we use August for the initial allowance. That means 5 months. Now, mind you, initial allowance, you are taking the whole initial allowance 50% off. So you bought the truck 10 million, you've taken 5 million as initial allowance. That's good. The remaining 5 million will be spread in 4 years. So 5 million spread in 4 years is like 1.25 million is what you'll be taking every year. That is what you'll be taking every year, 1.25 million. But you know, for the first year, you didn't spend the whole 1 year using the truck. So that 1.25 million has to be prorated according to the number of months used in the basis period. So we classify it as M. So M is the number of months, 5 months, all over 12 full months in the basis period. So when you do that, you will know your initial allowance for the first year. But for the second year and subsequent year, you will use the full annual allowance that you've calculated before, that you didn't prorate. It's only the first year you will not prorate it. But for the second year, third year, you use it like that. Now, in the year you are disposing the assets, if you didn't use it fully in the year of assessment, you still have to prorate. You still have to prorate because you didn't use it fully in the year of assessment. Okay? Now, when you have finished claiming all your capital allowances, let's say the whole 4 years, you are done with the whole 4 years, and now maybe you're in the 5th year, in the 6th year, then you find out that your capital allowances will give you 0 because you're not allowed to claim any month or any capital allowance after the capital allowances have been exhausted. So in that case, we will say M will be equal to 0. So 0 divided by anything is going to be 0. 0 multiplied by anything is going to be 0. Now, mind you, if your asset has not been disposed of, when we say disposed of, we mean sold. If you have not sold off your assets, it means that the asset is still in your books. Now, if your asset is still in your books, it means you must reserve 10 naira to show that the asset is still in your books. So let's say at the end of 4 years, you've claimed all your capital allowance. If there is nothing left in the asset side, you are telling the account that that asset is no longer in your coffers. That asset is no longer in your possession. So the 10 naira is just to show that you still have that asset listed in your asset schedule. You have not sold it. Until such a time when you sell it, then you will know whether you will claim balancing allowance or balancing charge. Of course, when it has remained 10 naira and you sold it, there is no way you can claim balancing allowance. You should be having balancing charge because you'll be making profit from what you sold. Now we have rural investment allowances. These are allowances that have to do with when there are no facilities and you are trying to provide those facilities. So these are the rates of annual allowances that you are given. Then we talked about the basis period for capital allowance. We said before it's the same basis period for profit, but we have to smoothen out the overlapping and the gaps. Okay, we've talked about on capital allowance. Now, capital allowance is given priority by the tax office. So capital allowance is given major priority over kind of loss or tax. So the government is saying that if you have an asset, you bought an asset to do your business, you must have spent so much. They are giving you an easy landing that instead of you paying tax to us, clear off your capital allowances and anything that is remaining, you can from there and pay tax to us. So, but the government in their benevolence is doing that. So they will say, instead of taking all the money you made in claiming capital allowance, just take a portion. So that portion that you are taking is 2/3 of your accessible profit. Remember, I said before, accessible profit minus your capital allowance will give you the taxable profit that will be subjected to tax. And so if you have to remove all your accessible profit as capital allowance, the government will not have money for tax. And so they say, take 2/3 of your accessible profit as the maximum they can allow. Okay, sorry, as the minimum they can, is the maximum they can allow is 2/3 of your capital allowance. The reason why they're allowing that as your maximum is that so that 1/3 of your accessible profits will be subjected to tax so that the government can get money from that 1/3. So if you have an accessible profit of, let's say, 90,000, 2/3 of 90,000 is 60,000. Your capital allowance will not be more than 60,000 that you can claim. So if you have 80,000 to claim as capital allowance, you have to claim only 60 and carry the remaining 20 forward to the next year. When you claim 60,000 as your capital allowance, the remaining 30 is where they will charge your tax. Now, this restriction is applicable to every industry except those that are into manufacturing and those that are into agriculture. So if you're into manufacturing or into agriculture, they will give you 100% of your capital allowance. So if you're into agriculture or you're into manufacturing, they will give you all 100% of your accessible profit as your capital allowance. That is, if you have more capital allowance to claim than your accessible profit can carry, they can allow you to take all your accessible profit as your capital allowance. So that 2/3 will not apply. Now, there is what we call carryback of capital allowances on cessation. Like I said before, the government are more ready to help businesses during the startup and especially give them an easy landing during cessation. Student is going back and forth. Okay, sorry for your network. Sorry for your network fluctuation. Now, the government is more particular on what a businessman stands to gain when he has unutilized capital allowances during cessation of business. Now, when a business has unutilized capital allowances and it is ending its business, let's say, for example, you have 1 million naira as your capital allowance, you have not claimed it, and you are ending your business this year, maybe July 31st. What happens to your unrealized capital allowance? You cannot carry it forward anymore. This is because your business is ending. Let's assume you have a loss in that year. You also cannot carry your loss forward. So your loss will be lost permanently. That's why it's called loss. It is going to be lost permanently. But your capital allowance is not lost permanently. That is what they call carry back your capital allowance. It means you have to take your capital allowance backward for 5 years. So right now, you are in the ultimate year. You bring your capital allowance backward to the penultimate year, and you refund whatever tax. They will refund you whatever tax you've paid so that you can claim your capital allowance based on that. If that is not solving your problem more, you take it again to the other year before the penultimate year, you do the same thing, get your refund of your tax, claim your capital allowance on the remaining taxable profit. If it still does not solve your problem, take it back again. So that's how you'll be taking it back for nothing more than 5 years. So from the penultimate year, you start taking your capital allowance backwards for 5 years. Students have gone off. So sorry. Okay, student is back. So we are saying that for carrying back of capital allowance on cessation of business, you have 5 years to carry them backward from the penultimate year. So if after carrying them backward from penultimate year 5 years back and it still does not solve your problem, then you cannot take it to the 60 year backward. That means anything that is left is seen as permanently lost. We will now look at one question and see how we can address capital allowances. James Nigeria Limited commenced business. So now you are looking at it, this is commenced business. That means commencement rule is going to follow. Now, as a textile manufacturing company, underline the word manufacturing. That means there is no restriction on capital allowance. These are the two things you can glean from here. Now, the company started on through basis period will start, and that will also be the starting of the basis period for capital allowance. Now, they said it was incorporated on 15th of March 2001. For now, we will ignore the incorporated date because that is not relevant to our problem. Its account for the first few years of its operation shows the following adjusted profit. Now, this is the adjusted profit. We are supposed to turn it into accessible profit. When we turn our adjusted profits to accessible profit, we will now use capital allowance to turn it into taxable profit. When we turn it into taxable profit, that is when we can now compute our tax. So let's see how we can do this. We're giving this adjusted profit. We have 10 months period ending in March. So when you see period means that it is not one full year. And they told us 10 months. From June to December is 7 months. Then if you count from January to March of the new year is 3 months. So 7 plus 3 gives us the 10 months we are talking about. So this is a 10 months period, is less than 12 months. You've seen it. Now this is a 12 months period, and this is a 12 months period. Now we are talking about the commencement. Now look at the capital allowances, the qualifying capital expenditure. Now, it is only on qualifying capital expenditure that you can claim capital allowance. Now, what are some of these things that are qualifying capital expenditure? We have factory building used for business purposes. We have machinery. We have furniture. We also have delivery van. We have motor vehicle, and we have office equipment. The student has gone off again. We are sorry for your network fluctuation. So sorry. So I was saying that the capital expenditure are all these things you see here, as long as they are used for business purposes. So anything that is used for private use does not fall under qualifying capital expenditure. Now, required, we are told to determine the basis period for assessment. And we are seeing this word and again. I circle this word "and" because it shows there are two questions. So the first thing is to determine the basis period for assessment. Student goes off again. Determine the basis period for assessment. Then you determine the capital allowance for the first 5 years. So this question is showing you the process. Whenever you are asked to look for capital allowance, especially in commencement or in anything, first of all, look for the basis period for profit. Then look for the basis period for capital allowance. So this is what we are going to do. Now, the business started in June 1, 2001, isn't it? And we were told that in commencement rule, the basis period is from the date the business started to 31st December of that same year. For the second year, we are also told that it's going to be from the date the business started, you count 12 months. That's it. For the third year, it's supposed to be from the date the business is bringing its account. In this question, they are bringing the account to March. But why am I writing May here? Because if I wrote March, I have to start it from April. I have to start it from April 2001 to March 2002. But as at April, the company has not started operation. The company started in June. So there's no way we can write April to March. So since we cannot achieve that, we'll simply repeat the second year in the third year. So it's a direct overlap. It is from the fourth year that we start creating the templates. So look at the year look at the period the business is making its account to, March 31st. Now this is 2004. So this is 2004. Preceding year basis means year should be 2003. This is the month the business is bringing the accounts to. So 2003 March 31st is the preceding year. That means the account would have started in April 1, 2002. Use the formula I gave you. If you are here, just ask yourself what is tomorrow's date, April 1, and you bring 1 year ahead, backward. So you have set the template. For 2005, here we still carry April 1, 2004, 2003 rather, to 31st March 2004. Now that you've done your basis period for profit, this is what you should have been familiar with by now. By now, you should have been playing with it for commencement rule. You know it first 3 years, then the fourth and the fifth year, you know them. Let us see that of capital allowance. I said before that capital allowance will match that of profit. So if we look at the first year, look at the date it begins, the assessable profit, that is when the capital allowance should begin. Now, can you see when it ends? For the first year, you have no problem because the business is just starting, it will be perfect. Now, when we go to the second year, we'll have an issue. The issue is because there is an overlap. This starting date is also the starting date of this. So that means there will be a period of overlap up to where this one ends. So the period of overlap will be from June 1 down to 31st December. It's an overlap. So anything that occurs during that period from June 1 to 31st December will not be taken care of in capital allowance, especially we are talking in terms of initial allowance. So you see where this one ends, January and December 31st, 2001. Look for the day one, the next day. So if you look at it here, we have already treated from September to December. So look for the next day, January 1, 2002. That is where this capital allowance basis period will start. Now, mind you, you can find it inside this basis period for profit. Mind you, we are still considering this basis period from here to here, but we are saying that because we have an overlap, we don't want to treat the initial allowance 2 times. So for initial allowance purposes, we're taking January 1, 2002 and ends the whole thing where this one ends. You end it at the same date. So you see, this has taken care of the overlap. Now let's go to year 3. Did you notice too that year 3 was an exact replication of year 2? That means year 3 has a direct, complete overlap of year 2. So for overlap, we exclude the overlap period in capital allowance. So you see, if this is exactly this, that means the overlap is exact. That's why you see dash. So we go to the next year, which is this one here. If you look at January and April 1, 2002, we found out that there is an overlap because this one contains May 2000 before you get to May. So that means that April and May are overlap here. So we don't need to bring overlap. So you can even see here that there is May here. It also has April and May. We don't need overlap. So we exclude the overlap. So the overlap ends in May. That means June 1 will not have anything here. So we have not treated anything with June. So this one will start from June 1 instead of May, or instead of April 1, because April and May has already been treated in this previous side. So it's going to start from June and ends where this one ends. So you see here it's ending the same date. That's beautiful. Now, if you go to the next one here, which is April 2003, April 2003 has not been treated in anywhere before. Moreover, it is the next day after this one ends. So that's fine. So this will start just like this, and it will end just like this. So that's how capital allowance are being treated. Whenever the business is starting, both the basis period for profit and for capital allowance will be the same. But in year 2, you'll be seeing some overlap, which you have to remove the overlap and use. Year 3, you're going to see some overlap. You remove the overlap period and use. From year 4, you will not see overlap. So you start doing the whole thing. But in this example, because we did a replication of year 3 and year 4, you will see small overlap in year 4. So anytime you see overlap, you remove the overlap portion and use it. Whenever there is a gap, you bridge the gap and use it. Now that we've done the basis period for profit, we've done the basis period for capital allowance. Mind you, this capital allowance basis period is for initial allowance only. Why do I say it's for initial allowance only? It doesn't affect annual allowance, because annual allowance will take the basis period for profit as its basis period. But for initial allowance, we are going to be looking at just this period that we've clicked here. Why? Is because if an asset is bought during this period, this is where we will claim the initial allowance. Now look at factory building was bought on March 2001. But here we don't have March here. What we have here is 1st of June 2001. But how come we are having factory building that was bought before that date? This was because the business has not started as at March. The business started in June, and so anything you bought before the business starts, the tax authority deem it to have been bought on the day the business starts. So irrespective of the fact that it was bought in 25th March, the law sees it to have been bought on June 1, 2001. The same thing applies to machinery. This is in May, but the business was in June, so it is deemed to be bought in June. But this is October 2001. Yes, the business has already started, so it is also deemed to be bought in October, not in June, because the business has been bought. And you see, this furniture is still within the basis period for capital allowance, so it is put there. So the next one is February 28, 2002 motor van. We'll look for the capital allowance that has February 28 in it. So if we look at here, this is January, of course, so February will be inside here, so that qualifies motor van. We look at the delivery van is May 2002. So let's check. This is also May 2002. So it qualifies motor van. Let's check again. We have office equipment, January 2003. So we'll go to where we have January 2003. Obviously, it's here we have January 2003. So office equipment is here. And so that's the last asset that was recorded. So that is how you do your basis period for profit. That is how you do it. Do your capital allowance. Then you bring the qualifying expenditure. Just like this. This is the table I want you to use in the exam. Okay. Now, the second requirement says compute the capital allowances due for 5 years in respect of the qualifying capital expenditure by the company. So the question is saying, now that you've found the basis period for capital allowance and you found the assets that belongs to each of them, can you look for the actual capital allowance figure? So let's do it for those 5 years. I told you before, this basis period here is just for initial allowance. After that, this basis period has served their term. What we are using is this basis period. So what we have established is that in 2001, we bought these items. In 2002, we bought these items. 2003, we bought no item. 2004, we bought no items. So these are the things that will help us in our initial allowance. So this basis period now is gone. For capital allowance, we're going to be using this. So let's see what we did here. Can you see year of assessment, basis period? Yes, we still used the basis period, this capital allowance. Fine, we still used it just because we are calculating initial allowance. Fine. Look at factory building. It was deemed to have been bought here on this date. So look at what we did. For all the assets we bought in 2001, factory building, machinery, and furniture. Look at what we did in the initial allowance. We said we are not prorating it. So what we are doing is we have a table of 50%, 50%. So let's see. For factory building, we said it's 15%. Let's see. Factory buildings, industrial buildings, 15%. So 15% of the cost. It cost us 3.5 million. Sorry, my system decided to play tricks on me. So let me continue. Let me ensure that I'm seeing you when you are going off and on. All right. Now, this 525 we've calculated here, you see it's our initial allowance figure. So machinery, we established that machinery, plant and machinery is 50%. So I've just showed you where I'm getting those figures. I will not be coming back and forth here. So plant and machinery is 50%. The cost is 2.8 million. So we look for 50% of it is 1.4 million. That is what we kept here, 1.4 million. Then the next one is this furniture. From our table, furniture is 25% of the cost. So look at it, 25% of the cost is 187,500. That is what we kept here. So what we do is to add these three initial allowance we've gotten so far. We'll have 2,112,000. That is your initial allowance for 2001. Allowance. Annual allowance is calculated as follows. Look at the factory building. This is the cost of the factory building. You can see here, this was the cost. That was what is here. We less your initial allowance. You remember this is what we got, and we are lessing its appreciable value. You now divide it by the number of years. And I told you before, when we are giving an example of 25%, now looking at this example, 100, sorry, once again, it's my turn now to experience the network issue. It's my turn to experience network issue. So we said before, when we are talking about the number of years to use, I told you if there are 10% given as the annual allowance for furniture, factory building, as you can see it here, non-industrial building, annual allowance is 10%. Now it means that it's a straight line. You take 10%. How many years are you going to take 10% for you to get to 100%? It's 10 years. So we could say 100 divided by 10 will give us 10 years. So this is the 10 years. So it means that when we minus this cost, this initial allowance from the cost, anything we get, we divide by 10 years. So let's do it together. 3,500,000 minus 525,000. Now this is what you get as your depreciable value. And we said you're going to divide it by 10 years. So what we have is 297,500. 297,500. That is what we have here as our annual allowance for every year. But because we didn't use it throughout the basis period, we have to prorate this figure for the first year. So the first year, it is deemed that we use it in June. So it is deemed that it was used from June 1 down to the ending of the basis period. So it is deemed to be used during this period, which is 7 months. So we are going to divide this figure by 7/2. We are going to multiply by 7/12. Means we are prorating it according to the basis period. So this is what we got before. Sharing my calculator. This is what we got as our annual allowance. So we are going to prorate it by saying times 7/12. So it will give me 173,542. 173,542. So that is your annual allowance for the first year. Now this is how you'll be doing it for the factory building, for the machinery, for the furniture. You follow the same process. Costs minus initial allowance divided by the annual allowance. Divided by the annual allowance years, number of years for annual allowance. How do you know 100 minus the annual allowance rate, divided by the annual allowance rate, will give you the number of years. So when you divide, this is the amount you get for a full year in the basis period. But because you are prorating it for 3 months out of the basis period, it becomes 28,125. So when you get them together, so if you can see here, you can see from my answer here, look at the 3 of them, you add them up to get this final figure of your annual allowance for that year. So your total capital allowance is going to be the annual allowance plus initial allowance period figure. So this one plus this one will give you your total annual allowance. Now that's for 2001. Let's get to 2002. In 2002, we are told that we bought an asset, delivery van and motor car. Okay? Sorry? Assets that was bought in 2002. You look for the initial allowance, 50% of the costs, give you 250. For motor car, you look for 50% too of the cost, it gives you 600. So these are the 2 things you need here. So you see them here, 250 and 600 will give you 850,000 as your initial allowance. Now let's look at the annual allowance figures. Just the way we did it the last time, this 2002, the assets we bought this period is in their first year of use. So we'll look at initial allowance. Annual allowance here is cost minus initial allowance divided by the number of years for the assets. So you see it gives us 62,500. That is what we should be claiming every year. But the first year of use of this van, we have to prorate. So we ask ourselves, when was this van bought? This van was bought on February 2002. And when does our basis period end in 2002? It ends in March. So we'll say it was used in February, it ends in May rather. So it was used in February, it was used in March, it was used in April, it was used in May. So it was used in 4 months out of a 12 months basis period. So it means we are going to charge it at 20,833. That is how we will get the annual allowance for the motor van, delivery van. For motor car, we do the same thing. Annual allowance, you bring the cost minus initial allowance divided by the number of years. It means you are claiming 150,000 naira each year. For the first year, how do you prorate? This car was bought in May. If memory serves me right, May. That means it was used for the first time in May. When does the basis period end? My memory serves me right. It also ended in May 2002. That means it was used for 1 month in the basis period. So that's why you see me here saying 1/12 of this figure. So it gives me 12,500. So after getting these two figures, I will now put them here. This is for motor van. Excuse me. So this is for delivery van, and this is for motor car. Now, what is this 760,000 doing here? Let me explain that. Remember, factory building was bought in 2-1. So you find annual allowance for 2-1, which we've done. We'll also find annual allowance for 2-2. Remember, in 2001, we used only a fraction of it because it was not used for the whole full year. But in 2002, factory building, machine, and furniture are being used for the whole basis period. So let's go back to what we did. When we are calculating annual allowance, students have gone again, okay? When we are calculating annual allowance, remember this figure we got here before we prorate. Now for the year 2, we're not going to prorate them. So we are bringing this figure. If you look at what I did here, it's this same figure we are supposed to prorate, but we are not prorating them in year 2. That's this. Then you bring this same figure, which you got as your annual allowance before prorating, and that's it here. And you bring this figure. That's it here. When you add the 3 of them, it gives you 760 without prorating. So that's how we got 760 here. So when you add this 760 to these 2 up here, you have this 793,333 as your annual allowance for 2002. When you add it to the initial allowance, you are getting your total capital allowance for that year. That's fine. For 2003, what happened in 2003? In 2003, we didn't buy any assets that fall into the basis period. No asset we bought that was falling into the basis period, because you see equipment is in 2004. So in 2003, no asset was in that basis period, so there is no initial allowance. However, there will be annual allowance for this asset bought in 2001 and this asset bought in 2002. So that is what gives me 972,500. So let's look at how we got it. How did we get that figure? Remember, we are in 2003. So all the assets purchased in the year 2001 and 2002 will have their annual allowances charged in 2003. We established before that assets bought in 2001 gave us 760. So here we have repeated it again to give us 760 as our annual allowance each year. Now for asset bought in 2002, this was the figure we got before we prorate in 2002. So this was the full figure, and this was also the full figure we got before we prorated, just like we did this. So when you add these two together, it gives you 202,500 as your annual allowance for assets bought in 2002. When you add it to assets bought in 2001, you add them up, you are having 972,500. That is your annual allowance figure. So that's how we got this 972,500. And since there is no initial allowance here, the annual allowance will become your total allowance. That's fine. In the year 2004, we bought an asset called equipment. And we see that the equipment will only be the one having initial allowance. You know how to calculate. Now, the annual allowance for equipment, we are going to be finding a figure and which we are prorating. So this is the prorated value. Now all these other assets that was bought in 21 and 22, we know before from the previous example that their capital allowance is 972,500. So since we are still claiming allowance on them still, we put it down here. So this figure add to this 1875 is going to give you this 991,250. And when you add it to your initial allowance of 300, you have 1,291,250 as your annual allowance. Now for the year 2005, there is no asset that was bought. So there will be no initial allowance, but there will be annual allowance. All this factory building and all stuff will have their full allowance of 750, 760. Motor van, delivery van, we all have their full annual allowance as we calculate the other time of how much? 212,500. Yeah, 212,500. And also, these are office equipment which we bought last year. Now, bringing it to this period, we're not going to prorate again. We're going to use the full value. And so the full value of that is 75,000. So you add asset purchase in 2001 plus asset purchase in 2002 and this new asset purchase in 2004. We add that 47,500. That is what we have used here. And since there is no initial allowance, that becomes your annual allowance figure. Now that we've gotten our total capital allowance, we are now set for operation. The question says before that B, compute the capital allowances due for the 5 years. We've done that. In respect of the qualifying capital expenditure incurred by the company, we've just finished that in B part. So we are going to the C, compute the company's tax liability for the first 5 years of assessment. So all we need to do in this C is bring our initial, where is it? Okay, this is it here. All we need to do is to recognize the basis period for profit for the first year, 2001, from when the business started to December of that year. We'll bring the assessable profit that was given to us. Assessable profits given to us, they told us that it was a 10 months period. But we needed out of these 10 months. What we need is from June to December, which is 7 months. Now we're going to take it from these 10 months. So we say 7/10 times the figure given for us for 10 months gives us this figure here. Now, we have to bring in our capital allowance and less it. Now, mind you, it's a company that is into manufacturing. So all your capital, all your accessible profit will go into settling capital allowance. So you see, you have got your accessible profit, and this is the capital allowance that we got from our workings previously. So if you can remember this figure, that is your capital allowance for 2001. That is what I am using for 2001. Can you see here? So you less it, this is what is taxable. This is what the authorities will spend on tax and they will charge you on tax. And now you are going to look for 30% of this figure. Since it's a company, that will be your company income tax. Then you look for 2% of this figure. That will be your education tax. So that's all for year 1. For year 2, we do the same thing. We are looking for the same basis period. The same basis period. Okay? And we're having 12 months period to contend with. But the account we have there, this is a 10 months period. So we need to take this 10 months. And we need to take 2 more months from here. And that's what we did. We took our 10 months figure plus 2 months out of 12 of the next one. When we add them together, this is the figure we got. Now that's our accessible profit. That's our accessible profit. Then our capital allowance is that capital allowance figure we got by doing capital allowances. Okay? Then, when we less capital allowance from profit, accessible profit, we are having our taxable profit. So it is from this taxable profit, we are going to charge tax. It is from this accessible profit, we are going to charge education tax. Okay, that's fine. Then we'll go to year 3, we do the same thing. Year 3 is a repetition of the accessible profit basis period. So that would mean that whatever we have calculated as accessible profits here in year 2 is what we will calculate as accessible profit in year 3. But the difference here is the capital allowance which we computed in our capital allowance table. It's going to be this. So when you less it, you are having this figure here forming the basis for tax, while this form the basis for education tax. So that's for the 3 years. For the 4th year is the same principle. For the 5th year is the same principle. So you see, that's how it goes. Okay. This is how your capital allowances go. Okay. I'm having a little issue here. I would have loved us to take exercise 2.2, but I have 2 issues here. One, my system is almost going to go off. There's no light. System is almost going to go off. And secondly, I'm having some issues, health issues. So the drug I took is turning my head now. So I will need to calm down and get some sleep to function well. So these are the 2 constraints. But what we will do is that on Saturday, when we will have our 3rd class, we are going to take this exercise 2.2 because I want to show you what happens in capital allowance when a business ceases. When a business ceases, what happens to the capital allowance? I'm going to show you, then we'll enter the next topic, which is called loss relief. But let me just briefly highlight what happens when the capital allowances is reaching a cessation period. Now look at your accessible profits that has been given to you, so we don't need to go and start constructing. We are giving accessible profits. We are giving capital allowance. But the problem here, this is year ended, and this is year of assessment. Year ended is different from year of assessment. Year of assessment describes basis period. Year ended, or this year ended describe basis period, while year of assessment describe the tax year. So when we say year of assessment 2001 is 2001 figure. When we say year of assessment 2001, we have to look at the preceding year basis. So it must end in 2000. So when I'm looking at year 2001, I'll be looking at preceding year basis and I'll be taking this figure. That's what I'll be doing. I'll be taking this figure and I'll be taking this figure for capital allowance. Now the thing is this company is engaged not in agriculture and not in what again? Manufacturing. So we have to be using 2/3 of accessible profit to see whether the capital allowance qualifies to be claimed, all of it or not. So that's what we'll be doing. You find out that at the end, look at how it was 2/3. We did that 2/3. At the end of the ultimate year, we found out that we have unutilized capital allowances, which cannot be carried forward. So what do? We carry them backward. So if you look at this capital allowance that was supposed to carry forward, we have brought them backward. Okay, we brought them backward. Then look at our taxable profits before we pay tax. So we have refunded our tax. Look at the taxable profit we had before we paid tax. Now look at our capital allowance we brought backward. How many can we relieve? So in this case, now we'll not be doing 2/3 anymore. We'll be looking at this and this, which is smaller. This is a smaller figure that will be here. So the smaller figure here, we'll still put the same thing here. The aim is to see whether taxable profit will be 0. If it is not 0, that means we've come to our bus stop. But if it is 0, it means we can still take capital allowance to the next year. So you see here, as long as here is 0, there's a possibility we'll go to the next year. But what determines whether we'll go to the next year is this place. If it is 0, then everything ends here. If this one is not 0, it means everything ends here. If it is 0 and this one is not 0, it means there's continuation. So this one is not 0, it means we need to carry this one backward again. So you see I brought it backward. Then I brought our taxable profits. I'll show you how to get your taxable profits. Normally, it's going to be your tax which you paid times 100/30. Normally, how did you get our tax? We said 30% of taxable profit will give you tax. But now you are giving your tax, you find 100/30 of your tax gives you taxable profit. So that was what we did here. Look at the capital allowance we brought backward, and I told you between this and this, which is smaller, put it down here. Put it down here again. You have 0 here. As long as here is not 0, it means we still have to go forward. So we have brought it back again here, and this is the assessable profit, taxable profit that was charged tax before, so they have refunded our tax. So between this and this, which is smaller, you put the smaller value in both sides. Less. As long as we have a positive figure here, there is still room for going backward. We go backward, and you see here that this is the capital allowance. I told you between this and this figure to carry backward. Now this is the 4th year you carried it backward, so we are going to the 5th year. So this is this figure carried backward. This is your taxable profit. Now I said this and this. Put the smaller figure. So put the smaller figure in both sides, and you find out that here is 0. That means we can't carry anything backward. We are fully utilized. And if we had not had 0 here, anything that was here would have been completely lost. Anything that was here would have been completely lost. But thank God we have 0. So the next class, I'll be solving it in details, but you can still study a similar example if you can lay your hand on skill past question paper, November 2015, question 1. It shows a similar example. After that, we'll be looking at loss relief. I told you about loss relief. So that is mainly the next topic we are going to do on Saturday. We are going to look in details on this carryback of capital allowance because they brought it in skills level question 1, 2015. So they brought something like this, and so that is why I am doing this one. This is not exactly the same question, though. So just look at this pattern I'm going to solve for you and go and do that example to facilitate your knowledge. So right about now, we will be ending our class. Thank you so much for supporting. On Saturday, let me see what time it will be on Saturday. On Saturday, our tax class will be from 7 to 9. 7 to 9. So avail yourself of that 7 to 9 period. I believe you will be at home Saturday by 7. But if it is not going to be possible by 7 o'clock, let me know in advance so that you can use an appropriate time. Thank you so much for joining this class today. I wish you a safe journey, a good night's sleep, I meant, until our next class. So thank you so much and have a nice day.